Welcome back to the Automotive Market Minute, in which may or may not take just over a minute. My name is Jurgella.
My name is Phil Trzebiatowski.
And I'm James Sivco.
I am so pleased to say that July in general exceeded expectations. And I'm even more excited to say that these massive companies which have all this data, they cannot choose the SAAR like Fountain Forward can. We're going to talk about Fountain Forward dealership performance. We'll talk about U.S. light vehicle sales and U.S. margin debt. Some interesting things coming from Mr. Sivco and Mr. Trzebiatowski. SAAR estimates versus the street. The street ain't got shit on us. Breaking down gas prices, Ford deliveries by vehicle type, Ford struggling. OEM spotlights, revenue per vehicle sold and year-to-date sales, and U.S. auto lending standards and why your finance department needs to know about this and what they need to do next. Filski, go ahead. All right, so 137 dealers, 29 states. Very excited to announce that. There's a lot of green here. Mr. Sivco is putting his glasses on there. He's like, there's a lot of green here, a lot of positivity in the month of July. Traffic was solid. Leads were solid. Appointments were solid. New sales up 0.9% at Fountain Forward, while the market technically was down. Good to be a Fountain Forward client. Used sales skyrocket, 8.9%. Inventory is extremely tight when it comes down to used vehicles. We know that the auctions are very tight, but our dealers got very aggressive during the month of July. They kept their turn rates high, and they had a really difficult time in general getting more used vehicles, but they found a way to get them, and they found a way to turn them. Very exciting July in general. Gentlemen, take it away.
So what you're seeing here is you're seeing the last about decade in new U.S. light vehicle sales. And some of the prints that we've seen in recent months showing that the summer is hot. One of the cleaner explanations for why units are moving this well is the stock market. If I go to the next slide, you can see that margin debt as a share of GDP is sitting at a multi-decade high. This FINRA margin debt is now up over 4.6%. And essentially what this is saying is when households feel flushed with equity gains, some of that money then starts to show up in higher ticket vehicles. So we've seen this linkage between stock wealth, housing, and auto demand before. It's not the only factor, but it's a big one right now. And James, what else is contributing to this hot summer selling season that we're seeing right now?
It's not just a wall of money from the equity side that you're talking about where consumers are able to cash out and show up with cash, but bank lending standards. You can see the top graph here, it's the darker line, and it's fallen over about the past 4 years. So bank lending standards are loosening. Now, banks are not the entire auto market, but this helps. And so if your finance group has got a couple of partners, chances are a new bank partner will want to finance deals for you. And on the debt side, lending standards are as loose as they've been in really over the last decade. So a positive development in terms of banks willing to lend to consumers and specifically for cars.
And this matches what a lot of our stores are telling us right now. They're hitting objectives, dealer cash is coming in. And from our perspective, this selling season still has legs through Labor Day. Now, really fun chart here. Over the last 5 months, we've been predicting the SAAR. Our average miss has been 0.12 versus Wall Street's 0.14. We've been closer or tied now 4 out of 5 times, and July is a good example. Fountain Forward's estimate came in at 16.6, the street came in at 16.3, and the actual SAAR came in at 16.5. Same story in April. We are consistently on the right side of the street's error and tighter overall. I wanted to shout out the team at Fountain Forward, specifically our economic team in the background. We have made this proprietary Fountain Forward index, and we use the Fountain Forward dealership data as a leading indicator to predict how is this month going to finish up. And so far, 80% of the time, we've either beat or tied Wall Street.
I want to give a shameless plug to the Fountain Ford team, who has not sat back and obsessed over just digital metrics, but has taken a holistic view as to what is happening in automotive and continues to outperform Wall Street, which has an endless amount of resources and power in comparison to the extremely nimble yet dedicated team at Fountain Ford that continues to paddle their ass. Great job, Fountain Ford team. It is an honor to lead you. Carry on.
Well, the gas price story is going to be with us throughout the summer, but I think the good news, prices should be back down by the end of the year, but we have several more months of high gas prices. This is the margin for refiners. They now currently, it doesn't matter which way crude prices go, refining margins are very wide. That's showing up in gas prices. This chart here, you can see this is called the crack spread. And what it does is it breaks every barrel of oil into two parts motor fuels and one part everything else. And a big part of that everything else is diesel. You can see that there's just a lot of margin in here. The refiners are running themselves as hard as they can. Unfortunately, you'll see many stories of explosions or fires or accidents because they're running at 110%, trying to meet the very strong demand here in the US. We do not have a crude oil shortage. So we get every barrel here in the US that we need every day in the quantity ordered and at the right place and at the right time. It's just a question of converting it to gasoline. And if you look at the next slide, which is inventories, this inventory number, which continues to get kind of a little worse, is at a seasonal kind of a 20, 30-year low. But what's going to happen is they're going to run the refineries as hard as possible. That number is going to go sideways to slightly up. And then when everyone goes back to school and the driving season slows down in October, November, then we will finally have some kind of a normalization of gas prices. Next thing we want to look at here is pricing power. US manufacturers, and we have Ford and GM here on the left, have been able to capture bigger and bigger ticket vehicles. Ford especially has led the way in basically demolishing the car. So they have a vehicle lineup now that is all SUVs, all trucks, and one Mustang. So their truck deliveries as a percentage of all deliveries has skyrocketed. That has shown up in, some of this is COVID inflation, but you can see here on the left, Ford has done an excellent job getting those higher price units moving through the dealers. On the right side, these are global nameplates where we couldn't get the exact US data, but you can see pricing power has been pretty universal. With Kia and Nissan have been the only two nameplates that really haven't had a lot of pricing power, but Kia's killing it in units. They have had record sales after record sales and are taking market share with this pricing strategy of theirs. And Nissan really doesn't have great truck and SUV offerings. And so that's why they're kind of stuck there and not getting really the pricing power of the other nameplates. But the next chart here really drives home Ford's vehicle mix. This is probably 12 years of Ford's vehicles, and you can see the disappearing car. They're essentially not selling them anymore, and they are focused on big, fun vehicles, and they're really killing it. Now, that doesn't show up on first half stats here. You can see that Ford, the nameplate, is down significantly. Almost all of this is explained by a fire at one of their aluminum producers that really shorted them on their abilities to make F-150s, and they're having inventory problems. So we expect that to clear up over the near term and for them to get back in the lead again. Phil, Steven, you want to talk about some of the strengths we're seeing here in some of the manufacturers?
Yeah, so a question that I had there. So I'm well aware about the aluminum plant, call it 15 months ago, 18 months ago. Wouldn't we also agree, though, that the big issue with Ford is that they went really aggressive in the EV category, and they're, I think I saw something like 95% down in the F-150 Lightnings. Would you agree that, yes, the aluminum fire was an issue, but in many ways they would have rebounded more by now, and it was the other poor decisions that they made that's actually bringing them down mostly, or is that incorrect?
So the CAFE standards of the past couple of years have turned the car manufacturing business on its head. And it's no longer about meeting the best consumer demand with your lineup. It's about selling EVs and getting credits, and then selling the biggest possible car you can on the other side. So hopefully, as we've removed these CAFE standards, the car will be reborn in America again, and something between tiny EVs that nobody really wants and big giant armadas will be sold, because there is a lot of demand in the middle of that curve, and domestic manufacturers especially have been discouraged from even offering cars.
Steve, you mentioned some things that you've been hearing about or seeing about CDJR, Stellantis. What are you seeing on the horizon for them?
Great question, Phil. Well, first of all, something that I was going to address in my ending monologue, I can touch on it now. Everything that I say on the Automotive Market Minute is my opinion and my opinion only. And I use this because it's my ability to speak directly to dealers. And in the event that for some reason they have feedback, they disagree with me, they agree with me, whatever it may be, this tease them up a little bit to give me a phone call, share feedback, whatever it may be, and I learn from all of those discussions. With that said, on the Stellantis front, here's what I'm seeing. We're going back to real American vehicles. We realized that putting Daytonas on your lot that plug-in was a ridiculous idea. It was flat out dumb, and it cost us billions of dollars. We're going to go and we're going to make vans that you like for your family, and we're going to make Jeeps that you like, and we're going to have horsepower, and we're going to make the Rumblebee again, and we're going to make a Jeep SRT with a shitload of horsepower, like 630 horse, and we're going to keep the Trackhawk going. And until you tell us that you don't want to drive a Dodge and a Ram and a Jeep the way they were supposed to be built, we're going to build them that way, regardless of what anybody else tells us to do. That is what I think they decided to do. And I think they're doing it unapologetically. That is all my personal opinion. But go back and make a great Pacifica. Make a damn great Pacifica, and people will drive it. Make a great truck that rumbles, and people will drive it. And for me, a multi-Jeep SRT owner, make me a Jeep SRT that when I start it, it is as throaty as it could possibly be, and it gives me chills when it's sitting in the driveway. That is what I want. And I will pay for the $10 per gallon. That's my feedback on Stellantis. And I think only Stellantis can do that Mopar thing that they do. I think that that's what they're supposed to do. And I think that going to what James said about the cars and Ford, I think I just heard that there's going to be a four-door Mustang Toyota Camry coming out. Okay? No shot at the Camry. Camry's a great vehicle. But I don't mind if they want to go make a Mustang that's a four-door. They want to make a four-door vehicle. The Ford Fusion's gone. Got it. Loud and clear. But, you know, somebody's got to make a competitive four-door car in America. And I think they're going to try to do that. Do I think they should call it the Mustang? I don't know. How'd the Mach go for you? You know, it didn't go real well. But this is the best part. I get to come on this thing, give my opinions, and, you know, most of the time I'm just flat out right. I'm kidding. But I get to make my opinions, and we get to see in the future if we're right or wrong. And I think that's the whole point of this thing. So to wrap things up for this August update, we're going to talk about momentum. The national market delivered another solid print, hitting a 16.5 million SAAR in July. The street guessed 16.3 million. Our team projected 16.6 million, and actuals landed right in the middle. Of course, we were closer than the street. That marks 5 straight months above 16 million pace, the most consistent market stability we've seen in over 5 years. And that's important for every dealer to listen to, especially when it comes down to the service side. There are a ton of vehicles out there that we can service. Fixed ops definitely has plenty of room to grow. Now, if you look at OEM performance, the divide is crystal clear. Ford struggled in July, down 10.2% overall because their pure EV lineup collapsed nearly 75%. Buyers aren't biting on forced EV transitions. That's very clear. We've been calling that for a significant amount of time here at the Automotive Market Minute. Meanwhile, Stellantis is mounting a massive comeback, a 10% climb in June and surging 38% on North American shipments, because they listened to their dealers, fixed their pricing, and realigned with core American staples like Ram trucks and Pacificas. And our Fountain Forward network is proving that operational execution wins every time. In July, our stores saw digital traffic jumped 5.8% month over month and a staggering 23% year over year. New sales ticked up 0.9%, even though the overall market was down approximately 1.6% on average. You could fact check me on that, but I'm pretty sure. But the absolute breakout was on the used lot, where our dealers generated a massive 8.9% month over month surge in used sales, even while inventory was tightening. Why? Because with average new car payments sitting at $808 a month, high intent buyers are using your website to do the heavy lifting online before stepping onto your concrete. Of course, because you're making wonderful appointments. And let's be realistic, an interest rate bailout is not coming. With global treasury yields staying anchored at multi-decade highs, retail borrowing costs are locked in place. Your desk managers can't wait for rates to drop. It's probably not going to happen. This is important. They have to solve that $808 payment through smart desking structure, transparent pricing, and trade equity. Furthermore, those elevated yields mean elevated floor plan expense, something that we haven't talked too much about. Every day an aging unit sits on your lot past 45 days, holding costs are actively eating away at your gross. I know many of you are feeling that. Yet the opportunity is right in front of us. With FINRA margin debt hitting multi-decade highs above 4.6% of GDP, stock market wealth is fueling strong demand for high trim trucks and hybrids. I think the hybrid heater is officially upon us and going to continue. My marching orders for your store in August are simple. First, don't wait for Labor Day weekend. Put the pedal down now. Start your holiday campaign push right now while digital traffic is peaking. Second, turn your inventory fast to protect your gross against high floor plan costs and keep your foot on the gas with used trade acquisition to feed that 8.9% used jump. And third, make sure your online payment tools are fast and transparent, easy to use, easy to reach out to you, so you convert those digital clicks into physical deliveries. This market is extremely steady right now. Plenty of traffic is available, and momentum is on your side if you're out there hustling. Let's go win August on behalf of my esteemed colleagues, Mr. Phil Trzebiatowski and Mr. James Sivco. My name is Stephen Jurgella. It has been an absolute pleasure, and God willing, we'll see you again next month on the Automotive Market Minute.